Picture this. It's a random Tuesday, and you finally have exactly $100 sitting in your account that you don't need for rent, food, or your phone bill. You have extra cash, and you're ready to invest. You open social media to figure out what to do, and you're instantly hit with noise. Influencers screaming at you to turn that $100 into 10 grand in 30 days, pushing meme coins before they explode, or hyping up a penny stock as the next Amazon. The problem is, when beginners lose their first $100 chasing these viral shortcuts, they usually lose the confidence and momentum to ever try investing again. We are going to bypass all of that. Today, we are going to walk through a simple, intentionally boring system designed specifically to protect you from the psychological traps that wipe out new investors. But before we place a single trade, we have to clear step 0. You need to ask yourself honestly, if an unexpected expense happens tomorrow, will you need this $100 back immediately? If the answer is yes, do not invest this money yet. Investing requires capital that you can leave alone for years. Forced selling to cover a sudden bill forces you to take a loss at the worst possible moment. To figure out exactly where your first $100 should go, we use a triage process called the 3-bucket system. Let's start with bucket 1, safety. The Federal Reserve found that when faced with a $400 emergency expense, only about 63% of adults could cover it with cash or savings. Even worse, 18% said the largest emergency they could handle was under $100. If you have zero emergency savings, your smartest first move is putting that $100 straight into a dedicated savings account. Without a cash buffer, financial stress forces your brain to panic. This triggers loss aversion, where the fear of losing money drives beginners to sell their assets exactly when the market dips. Bucket 2 targets high-interest debt. If you are carrying a balance on a credit card charging 25% interest, paying that down is identical to earning a guaranteed 25% return. The stock market does not guarantee anything close to a 25% return. Trying to invest while carrying high-interest debt is a mathematical losing battle. Filling your safety and debt buckets first secures your financial foundation, ensuring you can actually survive market volatility later. Once you have a small cash buffer and no urgent high-interest debt, you graduate to bucket 3, actual investing. Step 1 here is choosing the right account. Prioritize an employer retirement match or a tax-advantaged retirement account before you open a standard taxable brokerage account. Take advantage of the lowest fees and highest tax efficiency available. Step 2 is picking exactly one broadly diversified index fund. That means a total market fund, an S&P 500 fund, or a target date fund. Avoid individual stocks entirely. This chart compares active professional funds against a broad market index. The index dominates. Even professionals struggle to beat the market. Over 30 years, a 1% active fee compounds, eating up over 30% of your final portfolio compared to an index fund. In long-term wealth building, a boring, low-cost approach mathematically defeats expensive, active trading. Step 3 is executing the purchase using fractional shares. You do not need to wait until you have enough cash to buy one full share of an expensive fund. Fractional investing lets you specify your exact $100 and own a proportional slice of the market. Now for the final and most critical step, setting up an automated recurring contribution. Start with a small amount, like $25 a week. This area chart plots a single $100 investment over 30 years. At a 7% return, it yields a flat curve ending at $760. Automating $25 a week at the same rate rapidly expands the line into a massive exponential curve, yielding roughly $120,000. That $120,000 result comes from consistent execution, removing human motivation and willpower from the equation entirely. Your brain will naturally fight this system. It wants the excitement and the illusion of control that comes with picking individual stocks. Buying the whole market just feels passive. But research from Dalbar shows a massive gap in reality. In 2024, the S&P 500 returned over 25%, while the average equity investor returned only about 16.5%. That gap exists because human behavior destroys returns. Fear, ego, and impatience cause beginners to buy high out of excitement and sell low out of panic. So here is your challenge for the next 24 hours. Execute just one step of this plan. Put $100 into an emergency buffer, pay down a high-interest credit card, or buy a low-cost index fund. Building this automated financial system removes the pressure of daily decisions, turning you into a consistent, disciplined investor.